Something that I do to become a better investor is look at successful investors that have really achieved great returns and have published books and really share the process they follow, the keys to their success. And one of the investors that I really admire is Pat Dorsey. I've read his book and I've also have seen many videos of speeches and presentations he's made. Overall, I really identify with his process. I think he really nails a couple of points that I believe in. So, in this podcast, I wanted to talk about Pat Dorsey, review his methodology of investing, what the keys are to successful investing according to Pat Dorsey, give you an insight into his portfolio, show you the investments he's making, some of the transactions he just did a quarter ago. And I'll end with a video interview of Pat Dorsey that was conducted with Brown University asking him questions. So there's a reason why Pat Dorsey is one of my favorites. And it really is because I really identify with his style of investing. I think his approach is similar to mine. I have a lot of experience working professionally and overall and looking at companies over the years. And I think that his style of looking qualitatively at a company is really fits the way that I like to look at companies. As you've seen my videos and look at how I analyze companies, the qualitative step is really important. Why look at the numbers if you don't believe in the business? Why look at the numbers if you don't think that business is desirable? So I always look at the desirability, the qualitative aspects of a company before I dig into the numbers. And that's one thing that Pat Dorsey really buys into is the moat of a company and the overall competitive advantages of a company, which really I highlight as well in my videos. And I really believe I really have to believe in a company before I invest in them. And I also like that Pat Dorsey makes his methodology and his practices readily available. He's published multiple books, he provides interviews, and he runs a fund, which I have access to some of the information based on the reporting that he has to complete each quarter. So that's the reason why I really like Pat Dorsey. Dorsey has published a few books, and the one that I read and I really liked was The Five Rules for Successful Stock Investing. It really makes sense to me. I think it's really laid out in a very modern way. And I would say that I've read the books from other investors, but those investors are quite old. And to this point, their ideas were working 40, 50 years ago. But this book here was written in the last 10, 15 years. So it really makes a lot of sense. A lot of technology companies are used in the book as examples, which really fits the time. And the five rules that he'll put in the book, just to summarize, is first, do your homework. You got to put in the work to understand a business. And it's not all financials. Really get to know the business, get to know their ecosystem. Who are their competitors? Who are their customers? How's their future look? Is their product really competitive? Those aspects of the company are really important to understand. You're only going to get there if you do your homework. Second, find companies with a strong competitive advantage or an economic moat. In short, I try to look for companies that resemble a monopoly. Now, that's not acceptable to the government, so to speak, but as an example, the government is taking Google Alphabet to task because they're so good, they're deeming them a monopoly. And that really reinforces that Alphabet Google is an excellent company, so much that the government has defined them as a monopoly. They have great economic advantages. They have an awesome business in that search business, and they have great businesses in YouTube as well as their cloud business. They have other businesses on the way. So those are the types of businesses that I believe Pat Dorsey is looking to find. Have a margin of safety. I like to call it discount. Margin of safety sounds like you're playing, conservatively, when I'm really trying to achieve a doubling of my capital investment in a company every 5 years. So I'd rather say discount, and I'd rather look at growth projections for a company. But I really identify with his point there. Plan to hold the stock for the long term. I'm a long-term investor. And long-term can mean 12 months. It can mean 24 months. If it's a cyclical industry, you got to determine your exit strategy. So you got to know where to sell, which is the fifth item. You can have a cyclical business. It's a wonderful business, but it's going to have its ups and downs. And if you don't know when to get out, You may ride up a nice appreciation curve, but also go down the decline curve. So, really knowing what is going to be your exit strategy is step number 5. So, the book really lays out great examples. It's clearly written for an investor. I really love this book. It's become my favorite book now, superseding the other books I've read in the past. Not only do we get access to Pat Dorsey's interviews and his books, but we also have access to what he invests in. He has the Dorsey Asset Management Company, and he has a portfolio of stocks, which I'm showing on the screen. And it's good to see his mind somewhat theorized in the book, but then see his activity in the form of actual investments. So his biggest investment is Meta. And coincidentally, that's my biggest investment. I noticed Smartsheet. Smartsheet was just announced that they're going to be acquired. So I'm sure he's going to do well with that investment. But you can see all these investments, several of them are more tech oriented, but you see some that are quite creative in going into older industries like AutoZone. So this is a good place for me to start and look at some companies, potentially as an example, AutoZone or the Sprout Social business might be interesting. I've looked at both and have analyzed the companies and continue to watch them. So Pat Dorsey, we can see his books, but we also get to see his portfolio. His performance has been very good for the past year. He's outperformed the S&P. He's at 31.36%. The 3-year performance is bad because I think 2022 is mixed in there, and 2022 was really bad. The 5-year performance is very good, and the 10-year performance is excellent. So it's good to see that he's a fund manager that's really been successful. That's one thing I would point out is if you go to like Datarama and look at a lot of these fund managers, most of them are underperforming the S&P, and some of them just have really poor performance. So I would say as you look at any super investor, look at their performance to make sure that, hey, they sound good, but do they perform really well in addition to that? So with Pat Dorsey, to me, he sounds great and his performance is really good. A little more on his portfolio. Here's the activity that he had going on in Q2 of 2024. He bought additional AutoZone. He bought additional Sprout Social. He trimmed back his position of Smartsheet, PayPal, Upwork, even Meta and Google. He owns a lot of Meta, as I showed earlier. So it's pretty interesting to see that a really successful investor, his portfolio is made public. So we can really, again, understand how he goes about it methodologically and then see actually what he's investing in. To me, it's a great training ground just to learn from one of the best investors in the marketplace. And now I'd like to show you an interview, a Q&A that was conducted by Brown University, where Pat Dorsey himself can share his philosophy and really hone in on how moats and competitive advantages are really important to keep in mind. I hope you enjoy the video.
All right, so thanks for having me. We'll chat for maybe 20, 25 minutes, and then we'll take questions. It's always much more interesting to hear what other people want to say than what I have to say myself. So what I want to talk about today is thinking about competitive advantage in a forward-looking sense. I think we're all used to thinking about competitive advantages. Let's look what the company has done. Let's look at published financials. But this is kind of moats 2.0 and thinking about competitive advantage from a forward-looking perspective, because at the end of the day, that's what really matters. Because as equity investors, we get paid on the future. We don't get paid on the past. So, quick introduction, Dorsey Asset Management, we're about $1 billion and change assets under management, largely institutional clients, 6 employees, very concentrated, currently have 14 positions. We focus on businesses with economic moats, reinvestment runways, and our process emphasizes primary research and qualitative insights. And you're going to hear this come up a lot in the presentation, the idea of qualitative insights from customers, from former employees, really informing a lot of the work we do. And I think it's kind of what you have to do to inform any kind of a forward-looking analysis of competitive advantage. So super quick, we'll start off with just sort of moat basics, moats 1.0. So what creates a moat? The primary test is pricing power, which is usually created via tangible assets like a brand or a patent or a license, the switching costs, network effects, or cost advantages. And moats, in our view, matter because they increase business value. They lengthen the period during which capital can be reinvested at a very high incremental rate of return. They can also reduce business risk by insulating the business from competition and exogenous shocks. And here's the key part for us active managers, they can be inefficiently priced because a go-forward analysis of a competitive advantage as opposed to a backward-looking one requires qualitative analysis. You can't just rely on the numbers. And reinvestment matters. This is where the forward-looking sort of moats 2.0 stuff comes in, because it maximizes the value of competitive advantage and it lowers the risk of value-destructive capital allocation. Let's give an example. So, company A has 20% returns on capital. Pretty good. It reinvests 30% of its cash flow, probably because its end market isn't growing very quickly, right? Probably because its end market is just not super high growth. So the business itself can only absorb 30% of its cash flow. The other 70% gets used for dividends and buybacks and M&A. Sounds great until we consider that, first of all, only a third of the cash flow actually earns 20% returns on capital, which is kind of what attracted us to the business in the first place. Also, we have real potential for value destruction. Most companies do not repurchase opportunistically at low prices. They just repurchase to sop up options dilution at whatever price happens to be in the market. And M&A's got a pretty sketchy track record. Some businesses that really focus on it get it right, but they're the minority. And so odds are pretty good that big chunks of that cash flow are either being used on low NPV, negative NPV acquisitions, or maybe neutral NPV acquisitions. Dividends are fine, but if they get paid to me, I have to redeploy that capital in a very competitive public equity market, right? I got to go out there and find something to do with it. And if it's in a taxable account, I get leakage, right? I get those dividends are taxed. So now let's consider company B. Same return on capital, right? 20% returns on capital, but the end market is growing at a rapid enough pace, or it has the opportunity to take market share such that it can reinvest 70% of its cash flow. Now, the bulk of the cash flow actually earns the return on capital that attracted us to the business in the first place. This is pretty good. We also have a lower capital allocation risk because the capital is reinvested. There's no hard decisions. Management doesn't have to say, okay, who do we buy to improve our growth rate or defend our moat? There's one decision: put it back in the business. Reduces your risk as an investor. Your return on the reinvestment is higher than what's typically achievable in public equity markets. And this is the key point, that the set of companies with sustainable returns on capital above 20% is way bigger than this set of equity managers with long-term net returns above 20%. So it's just a more efficient way to deploy the cash. For me as an investor, if they can take that money and put it back in the business, they're probably going to earn a better return than I can trying to redeploy that in a competitive public equity market. That's just math. So how do we analyze reinvestment? So first of all, when you want to think about whether the reinvestment is sort of positive or negative NPV and what the risk of it is, think about whether it's incremental or fixed, right? If you're launching satellites, Starlink, Iridium, Globalstar, building a giant factory, well, you get no cash flow until the investment is fully deployed. And so if the world changes between the time you dig the foundation and the time you're pumping out the first product, or if you run out of money or whatever happens, you're kind of in a bad place as an investor because it's a fixed investment that until it's complete, you're getting no cash flow. Compare that to hiring developers or hiring salespeople, where you can kind of, you hire a whole bunch of salespeople, sales aren't going so well. Well, you can slow your hiring or fire them, right? A lot easier to fire them than it is to basically, not pay the construction guys who are building your big old factory. So that incremental investment that can be ramped up or ramped down, usually has a little bit of a lower risk profile for you as the investor than a big lumpy investment that has to be made in its entirety before you generate the cash flow. The corollary here is that fungible assets like people are easier to pivot than fixed assets because sometimes the original plan doesn't work. And if it doesn't work, you can tell the developer, hey, instead of developing software with features A, B, and C, develop softwares with features Q, X, and Z, because that's maybe what the market actually wants. Whereas if you're building a giant factory to produce widgets, and the world don't want widgets, you're kind of stuck with a widget-making factory. You also need to think about the possible competitive response. If you're reinvesting heavily, well, you poke the bear, it might poke back. Slack discovered this with Microsoft. Microsoft declared Slack an existential threat. And so, teams got a lot better, a lot faster. And then also think about whether you're widening or marketing a moat versus digging a new one. It's easier and less risky to do a product extension than just create something out of whole cloth, or for the business to pivot into a direction it's never gone in before. You also want to think about the fact that investment happens on the income statement. And this is super important because things like sales or advertising or development costs, GAAP considers them expenses. However, the accounting rules may not match economic reality. It's pretty hard to argue, for example, that every developer in AWS, everything they're doing has zero value after 12/31/22. That's just, I don't think that's the case. I think that'd be a hard argument to make, right? And so some proportion of what a software developer is doing, although it's expensed, is probably an investment that's going to bring a benefit in future years. Ditto with marketing costs to some extent. If you're acquiring customers that might have a 5, 6, 7-year lifetime average life, well, again, the definition of an investment is spending money today for a benefit that occurs over future periods. Well, that sounds like a benefit that occurs over future periods because that customer is going to pay me for 5 or 7 years. And so what this kind of boils down to is that you as the analyst need to make the choice about whether an expense is an investment that's going to build future value or just a frivolous burning of cash flow. GAAP isn't going to do this analysis for you. You have to do it yourself. But the core question here is just to think about, how is a factory which sits on a balance sheet and depreciates, why is that more valuable than a brand or a group of sticky customers which are expensed, right? The effort to acquire them. So it's just, the key here is just you need to think about categories of expenses that are really investments when you're thinking about long-term margins and you're thinking about whether the investment is NPV positive or NPV negative. The corollary here is that GAAP losses don't mean something is a bad business. Again, are some expenses really investments? Are cash flows actually higher than GAAP income? And with options being expensed or negative working capital businesses, I can think of a few businesses with, the GAAP losses are hundreds of millions, but their cash flow break even, right? And so if your cash flow break even, you're just not as risky a business as if you're actually burning hundreds of millions of cash. And then critically, are structural long-run margins actually higher than current margins? So if a business is losing money because it's a high-cost steel mill and will always be a high-cost steel mill, it's a bad business, okay? If it's losing money today because it's expensing options, because it's reinvesting in customers with an 8 or 10-year lifetime value, well, it may still be a bad business, but it may not. You got to do the work to figure that out. And so the corollary here is that quantitative metrics may be of little value in analyzing whether investment is actually NPV positive, especially because in a digital world, if the invested capital is minimal, companies making really bad reinvestment decisions may have high returns on capital. Right? If your invested capital is a rented office and a bunch of servers, probably not even a bunch of servers now if you're using AWS, you've got this wonderfully high return on capital. Doesn't mean anything because the denominator is a meaningless number, right? So don't get lured into, this is a high ROIC business, it must be good. Maybe not. And also if high NPV reinvestment is expensed, a declining return on capital may indicate a brighter future, not a worse one, right? If you're investing in what's going to be a really great product that's going to generate a lot of value in the future. And again, the qualitative research methods are probably going to produce more robust answers than navel gazing at GAAP income statements. Another corollary is that, and I want to be clear about this, just because a business has limited reinvestment opportunity, it's not a bad business, right? Nestle is not a bad business. It It just means that capital allocation takes on greater importance as a source of value creation or destruction, right? You, as the analyst, have to spend more time thinking about, well, what is management going to do with all that cash that they can't plow back into the business because the business just isn't growing that quickly. The end market just isn't growing. Destructive M&A is your biggest risk, and consistently successful M&A requires real focus. Some companies are good at it, many are not. So again, I don't want to imply that if you can't reinvest all your cash flow, oh, it's a terrible investment, you should never look at it. It just means your analytical focus needs to be different, right? Your analytical focus needs to put more emphasis on capital allocation than it would in a business where the capital allocation decision is basically one decision: put the money back in the business. And so, again, circling back to the idea of what the numbers do and don't tell you, in a mature industry that generally capitalizes investments, the backward-looking quantitative evidence, what you get out of Cap IQ or Bloomberg or whatever, it may suffice to assess competitive advantage, right? Because the accounting rules actually kind of match economic reality, right? The ROIC actually has analytical value if the company's building a factory, depreciating it over some useful life, and that useful life roughly matches, with the depreciation schedule, roughly matches reality, right? The past may be a decent guide to the future. The problem, of course, is that if the evidence is there for everyone to see, the moat is more, let's say more likely, maybe not probably, more likely to be efficiently priced. Because what you can see, everybody else can see. Anybody with Cap IQ or Bloomberg or who just wants to spend time filing data into a spreadsheet. But in a dynamic industry, growing industry, that usually expenses its investments, software would be one example, there are many, this past quantitative data has much more limited value because ROIC is meaningless if there's not much invested capital to begin with, and if the investments are often expensed. The numbers doesn't tell you anything at all. And if the industry is changing rapidly, the past may be a really bad guide to the future. Herein, though, lies the opportunity. Because if the moat is not obvious to some quant running a screen, or some newly minted wet behind the ears MBA who's just staring at past financial statements, you can develop a variant perception by doing the work, by using qualitative insights. A little quick case study for you. So it's a company called Avalara that makes sales tax compliance software. The US has about 12,000 taxing jurisdictions. There was a decision by the Supreme Court, or SCOTUS, a few years back that basically changed the rules for when states can tax companies from physical nexus, meaning you got to have a warehouse here, to economic nexus, meaning as long as you're doing a certain amount of business here, we can tax you. Of course, with e-commerce, there's lots and lots more businesses that have economic nexus than physical nexus. So this company does sales tax software. We're like, hey, demand might go up for this stuff. Let's take a look at it. So key questions, what's the competitive landscape? What are the switching costs? What's the shape of the adoption curve? How big is the addressable market for this? And what's the long-term margin profile of the business? So what do? Well, first we built we thought was called the Wayfair Index, which was basically, Wayfair was the name of the court decision, basically trying to look at each state and what the population of that state was, and then when it was scheduled to implement economic nexus. So you get some sense of kind of when states and businesses in those states would kind of be forced to have some kind of sales tax compliance solution to implement. Sourced competitors, partners, ex-employees, spoke with over a 3-period, several former employees, competitors, consultants, ERP partners, and did a whole bunch of customer calls. And so the key insights from that was, first of all, it's a very benign competitive landscape. They had one competitor at the low end, which if you were bigger than a 10-person company, those were really going to use it. And then they had another competitor who was much more focused on big enterprises that, of course, have been paying taxes in multiple states for decades, right? Because they have employees all over the place. But that software wasn't very flexible, and it really wasn't very modern, and it really wasn't easily adopted by kind of your modal small, sort of medium-sized business. We discovered that the ERP integrations were critical to the moat, that basically Avalara had spent a lot of time partnering with pretty much dozens, if not hundreds, of ERP providers and making it easy to hook up to that system. Because if the system that is recording your sales and recording your inventory and doing your general ledger can't talk to the sales tax compliance software, it's of no value, right? And so these systems have to talk to each other. And if Avalara can show up and say, hey, we've already got this integration. We built it out years ago, and we got a bunch of clients using it. That's a much easier sell than, yeah, we'll figure it out. Maybe. Switching costs are very high, as you might imagine. It's a little bit like the payroll industry, right? If you think about companies like Paycom or Paylocity or back in the day, Paychex or ADP, basically you don't pay much for someone to calculate your payroll and the taxes that you owe. But if you get it wrong, you have these guys called the IRS that get really angry at you, and you don't like that. This is the same thing. Relative to the cost of this software to keep a whole bunch of states happy that we're actually filing our taxes on time, it's pretty low relative to the risk that 3 state comptrollers call you up next year and say, yeah, you didn't file your taxes here, you got some penalties, we're going to audit you. Not something you want as a business. And we also felt that operating leverage would be substantial because this is a volume-based business, so more sales get taxed, e-commerce in many, many states. Your cost of goods sold doesn't really rise with incremental volume, right? I mean, you're just doing a quick little calculation of what sales tax you get. And then, so higher ARPU creates revenue with minimal sales and marketing cost. And so the nut here, and I just boiled down several weeks of work into about 90 seconds, is what you want to do as an analyst, you're bounding future uncertainty using a wide variety of qualitative and quantitative sources. You want to think investigative journalism, not billions or Wall Street, right? That's what a great analyst does. They really are much more of an investigative journalist than they are a dude with a Bloomberg shouting orders at a trader. That looks much better on TV because it's more photogenic than like reading a 10K or talking to a customer. But it's not how value actually gets created in the market. And so what I want to wrap up with is just emphasizing the value of qualitative insight, because the outputs of competitive advantage and reinvestment and capital allocation, those outputs might be quantitative, but the inputs require qualitative evaluation because you can't screen for switching costs. You have to go talk to customers to understand the value proposition. You cannot assume reinvestment is NPV positive. You have to analyze the long-run economics yourself. And you cannot rely on the warm comfort of published GAAP numbers. You have to go out into the real world, gather messy and conflicting qualitative evidence, piece together a mosaic, and make a forecast that may look very different than the past. It's called sticking your neck out. And it's really, really hard to do. But frankly, it's the way that you generate alpha in this business. Because if you're looking at the same published data that everybody else is, odds that you're going to come to a variant perception really aren't that high. So the big message here is to turn off your laptops. Because all of the information is in the past, all the value is in the future. It's a quote from Bill Miller. The quantitative data is usually priced pretty efficiently because everyone's got it. A qualitative insight that you worked hard to go out and get yourself, that is going to be less efficiently priced because nobody else has it. Thanks.
Great. Thank you so much. I think that's a really, really excellent presentation. Do you use screens at all even to just source a list of companies, or do you have other ways for sourcing these companies?
The screen's only going to tell you what's already happened, right? And if you're looking at the screen, somebody else look at the same screen. So sourcing is very idiosyncratic. I think the best thing you can do to source ideas is, first of all, don't think of them as ideas. Think of them as businesses, right? Because if you start getting hooked on ideas, what happens is, first of all, you kind of can go down this path on, I would say, sort of a low ROI path, because you're going to learn all this stuff about a business, then that knowledge is not leverageable over future businesses, right? Because it's some special situation, something that's unique to that case. Whereas if you think about just learning businesses, and you say, wow, I think this industry has pretty attractive economics, and I'm going to start with this company here, then I'm going to look at its supplier, and I'm going to look at its customers, and then I'm going to look at its distributors. What you're doing then is each new bit of work you do builds on the prior bit of work you did, right? And you're creating information, knowledge rather, with a long half-life to it, right? That's going to take a long time to expire. And I think that especially when you're beginning in this business, people tend to take a shotgun approach. They sort of get excited by an idea they read, or they heard some manager talk about it, or whatever, and then they kind of look at a software business, and they look at an aerospace supplier, and they're just like stretched really thin. It just the better way to do it is just pick something, and then kind of spider out from there. Learn about that industry ecosystem, and then maybe it's a good investment, maybe it's not, and then move on. Learn something else.
Yeah, absolutely. I think that makes a lot of sense. And for our next question, overall, compared to in the past, do you believe that it is getting easier for companies to maintain their moats as a result of global scale, or harder for companies to maintain their moats because of the rapid pace of technological change?
CPG companies, for years and years, the two biggest parts of their moat were, first of all, brands, right? They could spend a ton of money on linear TV to generate, consumer awareness. And they had these distribution advantages because to get the stuff, you had to go to a grocery store, right? And it just took a long time to build that out. Well, now let's fast forward to 2022. First of all, the barriers to entry for advertising and generating consumer awareness are way lower today than 15, 20 years ago, because you can, put up a digital ad that's just targeted to, left-handed mothers with red-haired babies or whatever. And just focus on them. You couldn't do that 15, 20 years ago, right? So the barrier to entry to generate consumer awareness, so much lower than it used to be. And then distribution, someone else can do it for you. You can use fulfillment on Amazon. You can, do it yourself. There's so many more shipping services available today. E-commerce is, used by most people where it wasn't 15, 20 years ago. So, none of those companies are going to destroy, Campbell Soup or something. But when you think about most CPG markets, they're growing really slow. And so if lots of these hyper-targeted competitors that are satisfying some niche or speaking to some type of value that a small group of customers have, and they're just picking off, 10 bips of market share here, 5 bips of market share there. Well, when you're only growing 3 to 4% to begin with, it's not fun. So I guess that's not a statement about, whether the world is changing faster or more rapidly. It's more a statement around, the past is just irrelevant. What has happened just has happened kind of doesn't matter. So I guess I'm reluctant to generalize. I mean, you get all this kind of stuff around, moats aren't nearly as durable as they used to be. And I think some of that comes from people who own newspapers that then just got destroyed, or people who are seeing what's happening in CPG, these sort of long-time, very stable industries that are kind of, not having a great time right now. But I don't know if that means that competitive advantage is eroding faster all over the place, right? I mean, network effects are easier to generate today than they used to be. 15, 20 years ago, there were, in terms of network effect businesses, you had MasterCard, Visa, and the financial exchanges. It's kind of what you had, right? But now, with with social networking and with payment systems, it's just you've got way more businesses with that type of moat, which, again, generalizing, tends to be harder to destroy. So technology cuts both ways.
Yeah, absolutely. I think that makes a lot of sense. And how about we speak a little bit about how did you initially become interested in investing? And did you always feel that a sort of more moat style of investing was the right path for you? Or did you have some time where you were debating between, let's say, a moat type of investing and a more deep value style of investing?
Yeah, I mean, I'm not one of those guys who was reading The Intelligent Investor in high school. We just finished our interviewing for interns, and I mean, some of these, I'm like, if I was as smart as you at that age, I'd be running the world right now. They're just so far ahead of me. And I mean, I didn't really, no one even introduced me to, common stocks, uncommon profits until I was in my late 20s when I was at Morningstar. Before that, I just thought of businesses as little blinky things with charts attached to them. Quote the man. So, I was kind of later in life, and when I finally figured out that, investing was about understanding businesses. It wasn't about kind of, all this flashing screen stuff. And the competitive advantage angle of it, there's a couple things. I mean, one, my background in both graduate school and undergrad was in comparative politics, which is basically studying a small number of cases, of, usually historical events or things that have happened with countries, and then trying to extrapolate meaning from a small number of well understood case studies. Well, it sounds kind of like investing. Study 5 or 6 businesses and try to understand the similarities and develop pattern recognition. I was like, well, maybe I could actually figure this out. And I just find it, like, to me, it's just much more intellectually interesting to understand how a business does something well enough that consumers allow it to extract excess economic rents over and over and over and over again. Like, that's just a really interesting challenge. And then how did the business solve that challenge? Like, I just find that much more intellectually interesting than like the kind of jigsaw puzzle aspect of recharacterizing a balance sheet so that you write up the buildings that are carried on at cost, and then you go out and find out their market value. And again, that's not, I don't mean to disparage that at all. Like, that's a kind of financial sleuthing that can generate a lot of value. It's just I don't find it very fun, and so I find it much more interesting to understand just the functioning of the business and why it does or does not create excess value over time. Like, that's just, to me, it's a really interesting question, and the answer is different for every business, pretty much. So I just find that much more interesting than kind of the mechanical. And again, mechanical sounds pejorative, and I don't mean it that way. Than kind of the more quantitative financial analysis.